Picture this. You just learned that 9 EMA on a 5-minute chart is what some traders use to scalp the market. So you see the price creeping up to the level, you're pumped, you're ready to go. So you enter 3 NQ lots on a 150K top step combine. But the price runs straight through the 9 EMA, overshoots it by above 50 points, then turns around and you get your face smashed in for the entire $3,000 of daily loss limit. You are maybe right on direction, but you still end up with a big loss. What happened? You probably didn't take into consideration the market state for this particular day, nor the playbook that was happening, which might have been value rejection at that point, or maybe even a range-bound day, not a momentum trade. This is why I'm not a huge fan of only using lagging indicators for this purpose, especially not on such small time frames like 1 minute, 2 minutes, 5 minutes, without some sort of a larger picture context. So in this video, I want to break down why it's so important to understand the type of a day we have developing and how this plays into the decision of whether to use something like the 9 EMA or 21 EMA as a level of entry, or whether to maybe use it as a springboard for a momentum trade. You can even maybe consider using it as a mean reversion, or maybe if at this time this particular EMA level
is not relevant at all.
And to do that, I will turn to the topic of how to find liquidity pools and what to look out for if you are looking for reversals around these commonly used indicators. Before we go on, please make sure to like this long form video, comment on it, and subscribe to the channel for more stuff on all things order flow and auction process, etc. Why? Because the YouTube algo has turned nearly all of its attention to shorts and live videos, letting down some of us legacy channels like my own, and clearly favoring the channels who throw out bulk shorts that only give you like the tiniest 30-second or less bite-sized information. So throw me a lifeline and support the channel for free. It doesn't cost anything to click a like and to write me a comment for engagement purposes. It can even literally be something like, "What up? Word." In fact, you can just comment that, "word." So now we're going to get a ton of people who come to watch the video and there's like 20 comments below going word, 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 word. But all joking aside, if you do have a question about the techniques that I will be describing today, please pop them in the comments. I always answer relevant questions. My goal for this channel has always been to serve the trading community by sharing the trading experience that took a very long time to come by. And also because I got a little bit sick and tired of the Lambo bros telling you how easy it all is. It's not easy, it's never been easy, and learning to trade properly with any sort of longevity is one of the toughest things you will ever learn in your life. And sure, we see certain people who have lucky windfalls of making 100 grand in one day, and after that it's like daily loss limit, daily loss limit, daily loss limit bonanza until they've lost the entire 100K in the following week or so. Now, I want you to be here doing this for the next 10, 20, 30 years, and we won't get there by making lucky punts and sizing up like lunatics because you want to be rich yesterday. Easy come, easy go is something that heavily applies in this industry. Anyways, let's dive into the topic of using liquidity pools and order flow to make better trading decisions. In my previous video, I showed you some basics of bookmap and how on certain products such as ES and NQ, you can usually quite obviously spot the blocks of orders waiting. Now, the interesting thing is that these order blocks are almost always found around the areas of supply and demand and even VWAP, which stands for volume weighted average price. So even if you never intend to use level 2 data, there is always a way to spot these areas just by looking at the plain old candlestick chart, if you know where to look. Some basic rules around finding areas to look for are the following conditions. And by the way, looking at any time frame, very similar rules will apply. Order blocks, supply and demand areas, they will be zones that preceded a large movement away from them. Usually there's also some sort of basing, some sort of consolidation before the large originating move. And then once that move happens, you have a pretty decent reference area for pullback. So the noob trader who shorted at 9 EMA usually has some blinkers on, and they didn't do this sort of analysis. If they had, they would have seen the basing area followed by a bigger decisive drop away from the level, and then they would have marked off that supply where we would expect to see the same type of reaction, especially in the first touch of that zone. Now let's extend this basing area to the right of the chart. Oh look, the price touched it and promptly reversed, giving us a nice extended push down. Now, there are three ways to spot these reversals. One is to wait for a confirmation reversal pattern using only regular top-of-book price charts. In this case, we have a 2-bar reversal pattern. So your entry could simply just be that, right? The 2-bar pattern. Now, if you're trading a super crazy liquid instrument like NQ, this will be a novice level entry with a stop big enough to give you enough time to get involved without much drama and also to get out if the move starts breaking down. But if you're an intermediate trader, you might be able to front run this trade by using a couple of different confluences around the supply zone where we want to become a seller. It's very important to identify areas where you want to be a seller, where you want to be a buyer. Now let's add VWAP. Now this is overnight VWAP. I like to anchor it to the start of the previous day, which is usually 5 p.m. Central, or in my time at 11 p.m. I'm in London. I use overnight VWAP to gauge many different things. However, in this case, VWAP is providing a confluence with an existing supply zone. So if I want to front run this trade to get ahead of it, I will typically look to match the supply and demand zones with something like VWAP, or in absence of it, even something like a market profile related level, like the initial balance edge, previous day value area edge, or something similar. The actual entry trigger for me in this case will be taken on either Bookmap, or if you don't want to use level 2 data, which is not that necessary, and it's kind of a hit and miss with some people. So here's another way to look for reversals and these sorts of high probability levels. I like to drop down to either a 1 or a 2 minute chart. Now I still have a very simple tool of 9 EMA and VWAP, as well as the zone of interest where I want to be a seller. I would then wait for the price to A, touch the zone, and B, for the 1 minute candle to close below this 9 EMA, which is now plotted on a 1 minute chart. Now on Bookmap, you will typically see this event as a sweep. A sweep is a sharp vertical move in your desired direction when larger orders start flooding in, indicating a rejection of that level. But sometimes that reversal may not be via the sweep. Instead, it would be a gradual move away, depending on the time of day that you're trading and the time of day when the playbook setup appears. Some sessions and parts of the day are crazier than others. So if you're trading during the open, it's very likely that sweeps will be happening all over the place, making the whole tape reading quite difficult, especially if you're a novice trader. Now, the playbooks that I have involve a set of tools to examine at least 3 hypothetical scenarios using things like supply and demand on multiple time frames, market profile to zoom into the day time frame for the most likely direction, things like a gap fill, value rejection, failed auction, auction fade. Now those are setups. Setups are different than entry timing. So if we're looking to time the reversal with immediate order flow rather than order flow that represents existing moves, aka large inventory, that has already left its mark on the chart, then we need some pretty solid definitions for when we're going to enter. So here's a flow diagram of how to time your reversal, just to visualize it nicely and clearly rather than me just talking and throwing a whole bunch of charts at you. The way I like to do it, have a supply and demand area with a larger decisive move clearly visible. Match it up with another high probability level, in this case VWAP, but we can also use initial balance edge, previous day outer value edge, previous day high low, anything will do, depends on your style. And then finally, once the price arrives there, use a timing tool. Sweeps on Bookmap or even large bubbles on Bookmap. Alternatively, for top of book, use a 1 minute 9 EMA candle close below as a trigger entry. This way, you'll be setting up some super systematic processes over what you want to see around your levels of interest. So you will demand A, better price locations, and B, you will be able to minimize your stops somewhat And C, you will increase your risk reward on the trade, making this whole approach a lot more stable. Stability brings low variability into your P&L, and that's what you want in order to have longevity as a trader. Not these wild swings, up 100K, down 90K, up 70K, down 30K. It's like, yeah, you will be profitable, but there are very few people who can emotionally withstand those types of swings, huge swings in your P&L. It's, to me, it would be a very miserable way to live. There was this 60-year-old dude in one of the prop firms where I worked at, and he kept doing the following. One day he would be up 60K, and he's like, I'm the king of the office. I'm God's gift to trading. And then the very next day he would be down like 90K. So he kind of continued to scrape through 2 years before the firm actually let him go, because at the end of the year, after all of these wild swings, his take-home pay was like 20K. He would have literally been better off working as a cashier in McDonald's, which is a respectable job. Like, don't get me wrong, nothing wrong with that. But at the same time, learning to trade is such a difficult endeavor that takes a lot of mental capital, a lot of time, a lot of effort, that we really want to get something more out of it than minimum wage or worse, right? So this was a relatively short video just to show you how you can pair these somewhat complex tools into a more simplified, streamlined process. So that's it for now. Check out my previous mini-series on order flow if you haven't seen it yet. Here's the playlist.